Let's talk about the simple example of buying a house to understand what equity is. So, first of all, equity is essentially a measure of assets minus liabilities. So, it's essentially equal to net worth or net assets. Right? So, if we take a look at, say, a person buying a home, so they want to buy this house over here that's worth $100,000, but they can only afford to make a down payment of $10,000. Right? So, this is them with their green cash payment of $10,000, and then they're also going to take out a loan from this bank down here of the other $90,000 that they need to purchase the home. Right? So, in this example, their assets, so they're gaining $100,000 worth of assets in their house, but they're also taking on $90,000 worth of liabilities, right? So their net worth of this house, their equity in this house is $10,000. So this is what this house is worth to them, right? When they first buy it, this is how much of the house that they actually own. It's $10,000, right? So owner's equity in a business is simply the assets to the owner minus the liabilities, and so that's why the only of these four options that will work to explain owner's equity is D. This is the business owner's or owner's share of the company, which is also known as net worth or net assets. All of these other options, right? A is the amount of funding from issuing bonds, B is the sum of retained earnings and accounts receivable, and C is the total of retained earnings plus paid in capital. None of these actually show us how much of the business the owner actually owns, how much in assets and liabilities the owner has. All right, so that's D. Its net worth or assets is equal to the owner's equity.